Good evening. Oil price today, April 8th. Brent crude oil price crashes 15% as Trump agrees two-week ceasefire with Iran. What are experts saying? Brace yourself. The oil market has just experienced a shockwave, the likes of which we haven't seen in years. On April 8th, Brent crude prices didn't just dip, they collapsed nearly 15% in a single day. Yes, you heard that right. 15%. This isn't your typical market fluctuation. This is seismic. And here's the kicker. This dramatic drop coincided almost perfectly with reports that former President Donald Trump agreed to a two-week ceasefire with Iran. Coincidence? Maybe. Or maybe we're witnessing a highly calculated geopolitical maneuver designed to reshape global power structures under the cover of economic chaos. Let me walk you through this. It's important to understand that every move in this arena has layers of consequence, and the implications reach far beyond the headlines. It all started earlier this week, as whispers of back-channel negotiations between Trump and Tehran began circulating. Analysts initially dismissed it as routine diplomatic noise, but the timing is what's extraordinary. On April 6th, just 2 days before the oil crash, U.S. intelligence briefings reportedly indicated that Iranian forces were preparing to escalate activities in the Strait of Hormuz, the choke point for roughly 20% of global oil shipments. Think about that. If any disruption occurred, oil prices would have surged uncontrollably. Instead, they collapsed. That's not luck. That's leverage in action. And this leverage extends beyond immediate military implications. It touches finance, energy policy, and international diplomacy in ways that are rarely appreciated fully. Here's where it gets interesting. The two-week ceasefire effectively removes the immediate threat of Iranian retaliation, and yet the oil market responds with panic selling rather than relief. Why? Because investors aren't just reacting to today. They're pricing in the next 3 to 6 months of uncertainty. If the ceasefire is genuine, it stabilizes shipping lanes temporarily, but it also signals that future negotiations, sanctions adjustments, and global energy policies are about to swing wildly. Commodity traders are already speculating. If sanctions are eased or lifted, Iranian crude could flood markets by late May or June, sending prices even lower. In fact, Bloomberg reported that futures for Brent crude plunged from $102 per barrel to under $87 within hours. The numbers are staggering, and the ripple effects reach far into industrial sectors that depend on stable energy pricing. Now, let's talk strategy. Trump's decision here isn't just about de-escalation, it's about control. By agreeing to a short-term ceasefire, he shifts the narrative from reactive diplomacy to proactive leverage. He forces both Iran and global markets to recalibrate expectations around U.S. influence in the Middle East. It's a chess move, and the pieces are moving fast. Oil-exporting nations, especially Saudi Arabia, are suddenly caught between defending market stability and aligning with U.S. strategic priorities. Riyadh's next moves could determine whether oil prices rebound or remain depressed, and the clock is ticking. Every policy choice, every public statement, every small shift in energy output carries amplified consequences. Financial beneficiaries in this scenario are already emerging. Hedge funds and sovereign wealth funds that anticipated a short-term volatility spike have positioned themselves to profit from the crash. Those holding short positions on Brent and WTI crude have seen immediate gains. Meanwhile, U.S. shale producers face a more complex reality. Lower oil prices threaten profit margins, yet the geopolitical cover provided by a ceasefire could grant them breathing room to adjust production without fear of sudden supply shocks. For global investors, the message is clear. Volatility is opportunity, and the strategic timing here is no accident. Think about that. A 2-week ceasefire, a 15% drop in oil, and a recalibration of global energy markets, all within days. the leverage is shifting. The U.S. gains diplomatic flexibility, Iran gains breathing room to negotiate without immediate military pressure, and oil-dependent economies in Europe and Asia suddenly have to rethink budget projections and supply chains. Goldman Sachs analysts are already revising forecasts, predicting that Brent could see a temporary floor of $85 per barrel. But this is contingent on the ceasefire holding and no unanticipated escalations. The details matter, and each subtle movement in policy or market sentiment can amplify consequences in unexpected ways. Let's connect the dots further. The ceasefire coincides with a looming strategic deadline, the upcoming G7 summit in late April. At this gathering, energy policy, sanctions enforcement, and Middle East stability are on the agenda. The timing suggests that the 2-week window is less about immediate peace and more about setting the stage for negotiations, public relations wins, and possibly even election year positioning. If Trump or U.S. policymakers can present a scenario where global oil markets stabilize temporarily, they gain leverage in multilateral talks while shifting narrative momentum. This is not just about energy. It's about global perception, political messaging, and the delicate balance of power that governs international alliances. Now, here's a deeper layer most observers might miss. The market panic isn't merely about oil supply, it's about signaling. By allowing prices to fall sharply, financial and political actors test the resilience of global economies under stress. Emerging markets, which rely heavily on oil imports, are already feeling pressure. Turkey, India, and parts of Southeast Asia see currency volatility rising in parallel with oil price swings. Meanwhile, China watches closely, balancing energy security with its economic growth targets. This is high-stakes strategy playing out in real time. ANC News will continue tracking how these cascading effects evolve. But it gets worse. The 2-week ceasefire doesn't erase the risk of renewed conflict. If tensions flare immediately after April 22nd, the day the ceasefire is set to expire, oil markets could spike far beyond previous highs. Analysts at J.P. Morgan warn that a post-ceasefire escalation could push Brent crude back above $110 per barrel, creating a shockwave in commodity markets, bond yields, and even equity indices. Investors are acutely aware. The window is short, the stakes are enormous, and every move is under scrutiny. The interplay between diplomacy and market psychology cannot be overstated. This scenario also brings U.S. domestic politics into play. If energy prices remain low leading up to midterm elections, consumer confidence could benefit, but the long-term strategic cost might involve ceding leverage over allies and rivals alike. Conversely, if prices rebound sharply after the ceasefire, it could destabilize markets and provoke political criticism at home. The manipulation, or strategic timing, of market perception is as much a political tool as it is an economic one. Remember, the lines between economics, diplomacy, and military strategy have blurred more than ever. Who stands to lose? The obvious answer is energy exporters outside U.S. control. Venezuela, Russia, and even OPEC members that rely on higher price points may be forced to adjust production quotas rapidly. Russia, in particular, faces a delicate calculus. With sanctions still in place and global markets in flux, a sharp drop in oil revenues threatens both fiscal stability and geopolitical influence. Meanwhile, Iran has leverage to negotiate with more confidence, knowing the U.S. has temporarily constrained military options and that global oil dependence puts multiple countries on a knife edge. It's a multi-layered strategic dance. The ceasefire allows Trump or U.S. negotiators to signal restraint while keeping options open. Iran gains negotiation space without committing long-term concessions. Global investors are caught between volatility and opportunity, and every oil-importing nation is forced to recalculate policy, currency management, and energy reserves. This is high-stakes, high-speed geopolitical chess. Now, let's consider the medium-term picture, 3 to 6 months out. If the ceasefire holds and sanctions are partially lifted, Iranian oil could return to global markets in a trickle, depressing prices further. Shale producers might scale back production, OPEC could adjust quotas, and futures markets could see extreme volatility. By September, if a new round of negotiations fails or escalates, we could witness unprecedented price swings that ripple across equities, bonds, and foreign exchange markets. Every government and investor will have to adapt quickly or face major losses. ANC News will keep breaking down each movement as it unfolds. The strategic question looming over all of this is profound. Is this truly a temporary de-escalation, or is it a carefully calculated maneuver to reset global power dynamics, influence energy markets, and reposition the United States at the center of both diplomacy and economics? Every indicator suggests that the timing, scale, and market reaction were engineered for maximum leverage. The drop in Brent crude isn't just a number, it's a message to the world. Whoever controls the narrative controls the outcome. So what happens next? The ceasefire, while officially just 2 weeks, is effectively a countdown clock. Investors, policymakers, and military strategists are all watching the days tick down, aware that April 22nd could trigger either reconciliation or renewed volatility. The next G7 summit, ongoing Middle East negotiations, and domestic U.S. political calculations all intersect in this compressed time frame. Every move will have consequences that ripple through oil markets, national budgets, and global power balances. In conclusion, what we're seeing today is more than a market reaction. It's a strategic masterclass in timing, leverage, and high-stakes negotiation. The crash of Brent crude, the temporary ceasefire, and the recalibration of global energy politics are deeply interconnected. The implications over the next 6 months could redefine alliances, market behavior, and the very structure of global energy dependency. The chessboard is set, the pieces are in motion, and the game is far from over. ANC News will continue to analyze, interpret, and bring you every layer of this evolving crisis. The forward-looking reality is clear. The geopolitical chess match has only just begun. Oil, diplomacy, and military strategy are converging in ways that will shape the coming months. Those who follow closely will see patterns others miss, understand leverage others overlook, and anticipate moves before they happen. This is not just reporting, it's strategic analysis in real time. The world is watching, the markets are trembling, and ANC News will continue tracking every development as this high-stakes saga unfolds. There is so much more to explore, so many angles to examine, and every new piece of intelligence, every new market shift, only adds depth to the story, making it essential to stay informed continuously.